Thank you very much, Peter, and thank you for inviting me today. And this event really couldn't come at a more important time, just as more and more people are at least beginning to understand some of the implications of monetary policy of the last few years. But it's important to understand that actually inflation is really just the tip of the iceberg in terms of the consequences of central bank policies. Over the last few months, we've seen a series of bank failures in the US, and last year we saw the near blowing up of parts of the British pension system as a result of so-called liability-driven investments. And this caught a lot of policymakers by surprise. Yet in actual fact, most of this was very predictable. So I actually gave a series of speeches here in the European Parliament through 2018 and 2019, and actually even some years before that, talking through some of the consequences of 0% interest rates. In particular, the extraordinary distortions that were being caused to the economy and the historically unprecedented buildup of risk in the economy as well as a result of these policies. But it's also important to understand that this huge buildup of risk and debt has not just taken place just in the last few years, but actually over the last generation or so, really from the 1980s onwards, what we've seen is central banks responding to each recession by creating a series of larger and larger debt bubbles, by setting interest rates lower and lower. So this current roughly $300 trillion global debt bubble that we're in, which is just beginning to unwind, is not something which just built up during COVID or even during 0% interest rates. This has been inflated over the course of 40 years, which is something quite historically unprecedented. So today I'm going to talk through a couple of issues that relate to this. First of all, I'm going to briefly outline the current monetary system, and in particular, how money is created in a modern economy. And then I'm going to touch on a couple of key economic thinkers, which help us understand the predicament in which we now find ourselves. So first off, then, the current monetary system. How is money created in a modern economy? And this is crucial to understand. So the vast majority of economics textbooks, in fact, almost all of them, teach something along the lines of the following. What a bank does is it takes money from a saver, it leaves some in reserves, and it then lends out the rest of it to borrowers. So, for example, Joe walks into a bank, he deposits $10,000, and the bank, for sake of argument, leaves 10% of that in reserves and lends out the other $9,000. And it may, for instance, charge 6% interest on those loans and pay 3% interest to Joe, so-called fractional reserve banking. So that's what's taught in almost all economics textbooks. Yet this is, in fact, entirely false. In reality, in a modern economy, when a bank makes a loan, it creates that new money out of thin air. So if you go into a bank and you want a mortgage to buy a house of, let's say, £500,000, the bank does not go into its reserves and find a pool of savings of £500,000 and lend it to you. It simply creates that £500,000 out of nothing. Now, you may well find this quite extraordinary. And in fact, I've explained this to a number of people over the years, and I've even had some very senior people in banking and even central banking that have been quite incredulous. So I interviewed some people right at the top of this system over the last few years, including William White, who was the chief economist at the Bank for International Settlements, that is the central bank of central banks, based in Basel, responsible for the Basel regulations, which you may well have heard of, and also Lord Adair Turner, who was the chief financial regulator in the UK, and has also actually worked with the Bank for International Settlements in Basel as well. And indeed, they both confirmed in these interviews, which are published, that banks do not lend out savers money. When a bank makes a loan, it simply creates that new money out of thin air right there on the spot. But you may well be thinking then, are there some ethical considerations with this system? And indeed there are. So if we return to our previous example then, if you want to buy a house and you go into the bank to borrow £500,000, the bank then creates that money on the spot. £500,000 of new money is created into the economy. And you then proceed to spend the next 30 or 40 or 50 years paying interest on this money and, of course, paying down the principal. And in fact, now we're seeing the first multi-generational mortgages being given. But then, of course, additionally, if you happen to get into financial difficulties, if you lose your job, for instance, and you're unable to make your mortgage payments, the bank will then take your house from you and it will sell it in order to pay off that mortgage. So you, in essence, will be living your life as a debt slave based on money that was simply created out of nothing by the bank at that moment in time. But there's also one other point relating to how money is created, and that's the macroeconomic aspect. So just as new money is created when a bank makes a loan, when people pay off debt or when they default on their debt, that money is actually destroyed. It simply ceases to exist in the economy. So what we see is during boom times, when assets are going up in value, we see a lot of money created by banks in the form of loans. But then when the credit crunch hits, assets fall in value, people default on their loans, that money is actually destroyed. So this is what we call a pro-cyclical monetary system. It gets into feedback loops, both during the boom and then also during the bust. And that then brings me on to the next part of my talk today, then, which is looking at a couple of key economic thinkers who are relevant for understanding the consequences of this. And the first is Richard Cantillon, who was an 18th century French economist. And the second is Friedrich von Hayek, who was a 20th century Austrian economist. But today we'll actually start with Hayek. And one of his key ideas was that interest rates are a critical pricing mechanism for the economy. So in many respects, similar to the price of food or fuel or consumer goods. And if we think about when governments, for instance, set the price of food artificially low, for instance, in Venezuela, we know what the consequences are. There are food shortages and in many cases starvation. So really we should not be surprised that when central banks set interest rates artificially low, what we end up with is these huge debt bubbles, but also other far more subtle forms of distortion to the economy. But as I mentioned in my intro, this is not something that's just happened over the last 5 or 10 years. Really, from the 1980s onwards, central banks across the developed world have responded to each recession by setting interest rates lower and lower, thereby generating larger and larger debt bubbles. So if we think about America, for instance, when the bubbles of the 1980s burst, in property and some other sectors, in the late 80s, the response from Alan Greenspan in the early 90s was to set interest rates at 3%, the lowest interest rates for generations. And then following that, there were several years of the Greenspan put. And that all served to create an even larger bubble than that of the 80s. That was the dot-com bubble. And then when that burst in 2000, the response was even lower interest rates of 1%, which then created an even larger bubble, the housing bubble. And then, of course, when that burst in 2008, the response has been the lowest interest rates in history, years after years of 0% interest rates. And that, in fact, has created a far larger bubble than that which existed in 2008. So in 2007 and 8, the total global aggregate debt, that is household debt plus corporate debt plus government debt, was around $150 trillion. That was already by some margin the largest debt bubble in history, both in absolute terms and relative to GDP. But after years of 0% interest rates, that reached around $300 trillion of global aggregate debt. So in fact, far from bringing about a return to prosperity, what central bank policies like 0% interest rates have done is served to essentially double the size of the global debt bubble since 2008. Now, that then brings me on to the second thinker I mentioned, which is Richard Cantillon. And Cantillon was writing in 18th century France, and his key idea, which is important for us today, is actually known as the eponymous Cantillon effect. And that is the idea that when new money is created, the recipients of that new money benefit disproportionately. So in the days of Cantillon, this was the French royal court, those around the king. So they would receive newly created money, and they could then spend that money on goods, or they could invest it in assets. And then over time, that money would circulate around the economy. And the prices of goods would go up, and the value of assets would go up. And of course, the people who receive this newly created money last, i.e. the peasants, will have to suffer the consequences of those rising prices. But if we think about a modern economy in the 21st century, then, it's not so much those around the French royal court. The people who benefit from money creation, it tends to be large corporations, large financial institutions, and also speculative financial institutions, such as hedge funds. A hedge fund, for instance, if it needs to borrow money at 8 or 9% interest rates, it can only leverage up so much. And in fact, the majority of funds would not be really profitable if that was the case. But if they can borrow money at 0% interest rates, they can leverage up massively, and they're effectively artificially profitable. They're benefiting from this new money creation. And what they will also tend to do then is pull in resources from the rest of the economy. So we've all heard of physicists and mathematicians and engineers going to work for hedge funds and other speculative financial institutions rather than doing something productive and inventing things. And that's because those types of institutions have benefited from this system of money creation over the last few years, but to a certain extent over the last generation. And so to conclude then today, there's really three key points that I've touched on, which I think are important to understand if you want to get to grips with what's happening now and, in my view, what's going to happen in the coming years as things get much worse. And that is, first of all, the system of money creation. So the economics textbooks actually have it wrong. Banks do not lend out savers money. They, in fact, create new money when they make loans. And again, you can see the published interviews I've done with people at the BIS and elsewhere on this. Second of all was the idea from Friedrich von Hayek that interest rates are a core central pricing mechanism for the economy, just as important as the price of food or anything else. So what we've seen over the last generation of central banks setting lower and lower interest rates over the last 40 years, that's what has served to create the predicament that we're now in, which is an approximately $300 trillion global debt bubble. And then the third point I touched on was Richard Cantillon, and in particular his idea that when new money is created, the beneficiaries of this system are the people who receive that money first. So whereas over the last few years, many people's living standards have been essentially stagnant, some people have actually done very well over the last few years out of this system. And if you look a little bit more carefully, what you will generally find is that those people who did very well over the last few years are those people who were on the receiving end of the newly created money, the huge amounts of newly created money over the last few years. So thank you very much, everybody.